Welcome, everyone. My name is Joe Torre. I'm an investment counselor here at RealWealth Network, and I'll be your host today. Today, we're going to be talking about how to do your due diligence when evaluating a single-family home investment. So before we get started, let's get some housekeeping items. Next, we have our standard disclaimer. The strategies mentioned in today's presentation may not be appropriate for everyone. Other options not mentioned may be more suitable for your specific circumstances. Consult your personal accountant, tax advisor, and attorney to discuss your specific situation. So this is a broadcast to lots of people, and we don't know what your particular situation is, so don't take this as investment advice. What might be a good investment for one investor might be a terrible investment for another investor. So you have to talk to your IC and your advisors and get the input about your specific situation. And as usual, past performance is no guarantee of future results. Real estate purchases are subject to investment risks, including the possible loss of amounts invested. While we make every effort to maintain accurate and current info, the possibility of errors and/or updates always exist. So learn what you can today and do your due diligence, and we're actually going to talk about how to do that. All right, with that, let's get into it. All right, today here's the agenda. We're going to talk about an overview of due diligence, because due diligence is a big area, covers a lot, and you could spend hours talking about it. But we're going to focus on 3 areas that you, the investor, should be able to do on your own. And that is deciding what market you want to invest in, learning how to evaluate neighborhoods, especially now with the pandemic. People are reluctant to get on a plane and go visit neighborhoods on their own. So how do you do that remotely? And then also the pro forma financial statements that we give with all of our properties. How do you do a sanity check on those to see that the numbers that you're being shown are in the ballpark? Then we'll wrap it up and have hopefully some time for Q&A. Okay, overview. So like I said, due diligence covers a wide number of areas. There's markets, property management, finding tenants, evaluating neighborhoods, looking at the pro formas, deciding what property to get. There's a whole lot of financing options, inspections, insurance. So we could talk for weeks about this. But the good news is that RealWealth Network has done most of the heavy lifting here. We've done a lot of market research to identify the best markets around the country, and we'll talk about those. We've screened and vetted good property management companies in all of our markets, and those property management companies in turn will help you select tenants. So there's a lot of stuff here that you don't need to personally do yourself, because we've done it for you. We have an ecosystem of lenders who can help you navigate you through the financing process. We have inspectors, insurance people, everybody. The 3 that you need to focus on are the markets, the neighborhoods, and the financial statements. And the reason I say that is because we've done 90% of the work on finding good markets. But the last 10% is up to you. You have to decide which market you want to invest in. Nobody can do that but you. You can talk to your IC and get ideas, but ultimately it's your decision. And then secondly, you have to be able to evaluate neighborhoods if this is an area you want to invest in. And then also do the sanity check on the pro forma financial statements. Okay, so let's get into it with markets. So here's an overview of the markets that RealWealth Network operates in. Some of them are in the Midwest, like Chicago, Indianapolis, Cincinnati, Cleveland, and some are in, one's in Baltimore, on the East Coast. The rest are in the Sun Belt, Dallas, Huntsville, Alabama, Birmingham, Alabama, Atlanta, and then Charlotte, North Carolina, and then our 3 Florida markets, Jacksonville, Orlando, and Tampa. So there's quite a lot to choose from. And here's what we look for when we identify markets. We look for job growth, population growth, a diverse economy, a landlord-friendly state. We look for positive cash flow, and we look for places where we can find good property teams. Sometimes we have a market that we like, but we can't find property teams that meet our standards, so we can't be there. We have to have good teams there. And all of our markets have pros and cons, and not all of the markets check all the boxes. Some markets in the Midwest don't have population growth. The population's flat or maybe slightly declining. Some markets like Detroit have not as diverse an economy as other markets. We like to see as many different kinds of industries there. So if you don't have all your eggs in one basket, if you have only one economy and it's going through a rough patch, then the local economy can suffer. And then landlord friendliness. Some states of ours are more landlord friendly than others. Probably the exception, the outlier is maybe Chicago as the least landlord friendly state, but the rest of them are pretty landlord friendly. By that we mean it's not hard to evict somebody if they don't pay the rent. There's no rent control initiatives on the ballot every year, that sort of thing. All right, so if you listen to our webinars, you'll find that they all sound good. If you listen to the Tampa webinar and say, oh, that sounds great, I want to invest in Tampa. Then the next week you watch the Cincinnati webinar and say, no, now I want to invest in Cincinnati. So you have to decide which one you want to go with. So I'm going to give you some parameters to help you make your decision, and you can consider those when making your decision. All right, so what I have here is a simplified view of markets with appreciation on the y-axis and cash flow on the x-axis. And so what we see here are some markets that a RealWealth network is not in. San Francisco, Manhattan, Seattle, those are really expensive markets. You notice at the bottom there's negative cash flow. And so those markets have prices so high relative to rents that they have negative cash flow, negative 500, negative 1,000 a month. And RealWealth Network doesn't invest there. A lot of people got into trouble in 2008 because they bought properties with negative cash flow like that, hoping that the value would keep going up and up and up. And when it stopped, the music stopped playing, they were stuck, left holding the bag, and they lost a lot of money. So we don't play in that space. At the opposite extreme, we have some markets like our Birmingham market, Baltimore, and most of our Midwest markets, where you can get really good cash flow because prices are low relative to rents, but the appreciation is going to be low, probably in line with inflation, like 2 or 3%. Now, of course, that's a generality. In any city, you might have pockets of appreciation here and there, some neighborhood that's becoming trendy, millennials are moving there, or maybe just because interest rates are so low, there's a general rise in prices. But for the most part, the properties here are mostly for cash flow and you can't expect them to appreciate very much. And then in the middle, we have most of our Sunbelt markets: Atlanta, Charlotte, Huntsville, coastal Florida, anything near the beach, and Dallas. And those markets have less cash flow than the other markets we just talked about, but they have more potential for appreciation. Why is that? Because population is growing, jobs are growing. So as more people move into the area, the demand for housing goes up. So rents go up and property values go up. So a lot of your decision about which markets to go for depends on what your primary goal is. It may be overwhelming to consider 13 different markets, but and that 13 webinars is a lot to watch. But if you decide on your goal, whether you're focused on appreciation or focused on cash flow, that can help narrow the list very quickly. Now, why would one person pick one market versus the other? Well, let's say you're relatively young, say 35, you're starting out, you have a long runway, you've got many years of work ahead of you. You might decide that you want to invest for appreciation. So you buy 5 houses in one of the appreciation markets, and the 5 houses at $250 each, and 10 years from now they'll be worth $350. Well, your net worth just went up by $500,000. So that's a good gain. And then you can then 1031 exchange those properties into other properties and build your portfolio. On the other hand, if you were 65, you don't need, appreciation 10 years from now. What you need is cash flow right now to replace the income from your day job because you're getting ready to retire. So in that case, you might want to sell your house in California and buy 5 or 10 houses in one of the Midwest markets or Birmingham or Baltimore to maximize your cash flow. So that's an example of why you would pick one type of goal versus another. And I talk to investors all day long, and there's all kinds of investors who have all kinds of situations. I had a doctor once who makes $1 million a year, ankle surgeon, and he didn't want cash flow because he's in such a high tax bracket, he would get killed in taxes. So we put him in one of the appreciation markets, I think it was Florida, and on a 15-year mortgage. And so because the mortgage payment was higher, he had no cash flow for 15 years. And then starting in year 16, he had a ton of cash flow, which coincided with when he was planning to retire. So depending on the investor's goal, we, the ICs, mix and match the right investor to the right market, and maybe with some financial engineering, and we try to solve the investor's problem accordingly. So these are some considerations. There are only 2 variables here, cash flow and appreciation. There are other things to consider. What happened? Oh, property type. So another consideration is property type. If we had a Z-axis on here, we could look at different types of properties. For example, multifamily housing, like fourplexes and duplexes, they cash flow a lot better. And you can get a multifamily house, say a fourplex in Jacksonville, Florida, that has the same kind of cash-on-cash returns as one of these cash flow houses down here in Birmingham. So it's not just a two-dimensional matrix. There should actually be a third dimension for property type, because that could have influenced the kind of property or market that you want to invest in. Not all of our markets have multifamilies. Florida and Dallas have them. So you might want to consider those if cash flow and some appreciation is a goal. Another example of property type would be renovated versus new. For $250,000, you could buy one house in Huntsville, which is an appreciation market, or you could buy two renovated homes in Birmingham, Alabama, which are cash flow markets. So which one do you want to do to build your portfolio? That's another consideration in helping you choose your market. Another factor, this is a big one, is inventory availability. Inventory is really tight right now. A lot of our markets are out of inventory or have one or two houses a month. It's really tight. Florida has been sold out. If you wanted to buy a house in Florida today, you'd have to put your earnest money deposit down and wait 6 to 12 months to get the house built. So in the meantime, Dallas, which we're going to talk about next week, has at any given time 30 to 40 properties all over North Texas. So if, for example, if you're doing a 1031 exchange, and let's say you need 5 properties, then that would automatically focus you on the markets that have the most inventory. Because if you need 5 houses, you don't want to look at 5, you want to look at 10 or 15. That way you can pick the best 5 or the 5 that you like the best. So you need to focus on markets with lots of inventory. So that's another reason to select one market over another. And finally, there's weather. Some people are just paranoid about Florida, about hurricanes. And a lot of these investors are here in California where there's earthquakes, and earthquakes don't bother them at all. But the thought of a hurricane frightens them, which surprises me, because at least with hurricanes, you have a week advance notice that it's coming and you can prepare. The property management company can prepare, the tenant can prepare, but the earthquakes, they just happen without warning. But go figure, some investors don't want to invest in certain areas because of tornadoes in the Midwest or hurricanes in Florida or whatever. So with these various considerations, you have to narrow down where you want to invest based on your risk tolerance, your goals, and what you're trying to achieve, and who has what inventory. So all of our markets have a story. They all have a good reason why we like them, and you have to decide at the end of the day which one you want to go with. So work with your IC and narrow it down and decide which market is best for you. Okay, with that, let's talk about neighborhoods. So here's a typical property. So let's say in the markets section, you decided you wanted to buy something in Florida. So the property team sends you this property, 123 Main Street. It's a fictional address in Ocala. Ocala is right in the center of the state, northwest of Orlando. It's away from the ocean, but it's a good market. And they send you the photo, and they send you the address and the pro forma financial statement. Now, if you're in someplace other than Florida, it's going to be really hard for you to know whether or not this is a good neighborhood to invest. Especially with COVID, a lot of investors don't want to get on a plane and go out there and visit the area as they normally would. But even if COVID wasn't a factor, you'd still want to be able to do a lot of your research online as much as possible. Let's say you're considering 5 markets. You don't want to fly out to 5 different locations. That'd be very expensive. If you could do most of your due diligence here at your desktop, maybe you could eliminate 3 markets right off the top and just make a short list of 2 and then fly out to those 2 only. It'll save you a lot of time and a lot of money and expense. So let's see how we can do that remotely from our desktops. So there's a couple of online resources that I use and we use here at RealWealth Network. So here's one. It's called niche.com, Niche.com. And it's a great website for providing information about areas. So up here at the top, you click on Find Places to Live, and then type in the address of the property you're thinking of investing in. Now, if it's a new construction home, you might not have, the property might not have an address yet because it's not built. So it may not show up, in which case you would just put in the zip code. So in this case, the zip code is 34472. So plug that in and this map comes up. So right away, we see a couple of good things about this area. It's near the freeway. I-75 right here is a major freeway, and that's great for a long-term investment for a couple of reasons. One, you can attract a wider pool of tenants. If your tenants live close to the freeway, you can attract tenants who work locally, or you could attract tenants who work further away. So they can hop on the freeway and go to jobs anywhere. Whereas if the tenant has to drive 30 minutes just to get to the freeway, then your tenant pool is much smaller. You're only going to be able to attract tenants who work locally. So when you have a vacancy, you'll have fewer people applying for your property. So I like being near freeways. Also, in terms of future growth, if you're a company and you're going to expand and build a new factory, build a new office complex, where are you going to build it? You're not going to put it out in the boonies somewhere. You'll probably put it near the major arteries. So having a property near a major freeway stacks the deck in your favor in terms of future growth. The other thing is it's near jobs. You can't see it on this map, but Ocala is just north of an area in Florida called the Villages. And some of you have probably heard about this. The Villages is the largest retirement community in the country. There's 80,000 retirees who live there, and the City Planning Commission has just given permission to double the size of the Villages over the next 10 years. Now, the people who work there, the groundskeepers, who maintain the golf courses, the people who work in the restaurants, the healthcare workers, retirees bring jobs. So all the people who work there, they can't live in the Villages because you have to be 55 or older. So they live in the next town over, which is Ocala, and that's why we like this market. So whenever they expand the Villages, you have a built-in tenant pool of people who are going to move to Ocala and work at the Villages. So far, so good. This is looking like a promising area. So let's go to the next report. The next report is the overall neighborhood rating. So this is rated a B neighborhood, and I'll talk more about what that means in a minute for those who aren't familiar with it. But B is a good grade for a neighborhood. And they have here a little button, little link, how are grades calculated and data sources. So if you're interested in how they calculate that, you can click on that and get more background information. But you can see the schools are pretty good. It gets an A for diversity, A- for weather. The commute's good, not too much traffic. Housing, good for families, jobs, cost of living, outdoor activities. So this area gets high grades and for livability. Now, since it's next to that large retirement community, I'm not surprised it doesn't score well on nightlife and health clubs, but that's okay because the people there, you don't need that. So this is so far looking pretty good. So just a word about the neighborhood rankings. Let's see if it comes up. Oh, okay, here we go. So this, you'll hear this term in real estate investing, A, B, C, D neighborhoods, and there's no official definitions, and it's somewhat subjective, but I like to make these definitions for myself. So let's get D out of the way right off the top. D is a war zone. That's where you have graffiti, boarded up houses, drug dealers on the street corner, drive-by shootings. Nobody wants to invest in the D neighborhood. So just eliminate that right off the top. So going up to A is the affluent neighborhoods in any city, and that's where the doctors and lawyers live. Very nice, best schools, best ratings for everything. The problem is they're so expensive, they don't cash flow very well. And so it's rare to be able to find a good investment property in those neighborhoods. The B neighborhoods are the good ones. Those are the ones where it's mostly a homeowner neighborhood where people own their own homes, and the people might be school teachers, nurses, let's see, firemen, the manager of the auto parts store, workforce people. They own their own homes and take care of their houses, but they're not in the same class as the affluent ones. A C neighborhood in my mind is a tenant neighborhood where most of the people are tenants. So a neighborhood with fourplexes and duplexes or all apartment buildings. There are exceptions. There are some really nice areas that have very good, high, well-maintained tenant neighborhoods. Like if you go to San Francisco, you'll find tenants who are attorneys and doctors making six figures, but they can't afford to buy the property, so they live in tenant neighborhoods, but their neighborhoods are still good. But that's kind of an exception. And the reason for the distinction is the tenant neighborhood tends to deteriorate faster, or potential for deterioration. People who rent don't take care of their house the same way a homeowner would. And so those neighborhoods can decline. So the sweet spot is typically a B neighborhood, and most of what RealWealth Network offers will be in B neighborhoods. The two exceptions are Baltimore and Chicago, which are tenant neighborhoods with mostly Section 8 tenants. And those cash flow really well, and that's why we're there, because some of our investors want those, but they're kind of an exception within our network. So far so good. This neighborhood's looking pretty good. So let's go on to the next report, the real estate report. This gives you a snapshot of what kind of real estate is there. Average home value is 116, median rent's about $1,000. The area feels rural. I was there a couple of weeks ago, and it does feel rural. Here's the key metric that I watch: rent versus own. As I mentioned earlier, tenants don't take care of properties as well as owners do. So I personally prefer a ratio of 2 to 1, a neighborhood where there's twice as many owners as renters, like 65% owners and 35% renters. And I like that for a couple reasons. One is it preserves property values. If you have a property in the neighborhood of all tenants, then it's iffy. The neighborhood might decline. It might be okay, but it might also decline. Whereas if you're in a neighborhood with mostly homeowners who have pride of ownership, they mow their lawns, they make sure no trash collects on the lawn, they have nice cars, your property value is preserved when you're in a primarily owner neighborhood. The second thing I like about owner neighborhoods is I have multiple exit strategies. 10 years from now, when I go to sell the property, I can sell to the tenant, or I could sell to another investor, or I can sell to an owner occupant who's going to buy the property and move into it and make it his primary residence. If you're in a tenant neighborhood, you pretty much have only one exit strategy, and that's to sell to another investor. And investors don't have an emotional decision. To them, it's just dollars and cents. So they drive a hard bargain, and you're likely to get less money for your property. So the fact that I can get multiple exit strategies make me personally look for a preponderance of owners. Now that's just my rule. I like 65-35. You don't have to follow that. You can have your own, but that's just what I do. All right, the next report is the residence report, which gives you a feel about who lives there, who lives in this area. So we get an A for diversity. I'll talk about that more in a minute. The household income is only 45K, which is not much in California, but in Central Florida is not bad. And if you look at the education levels, you see there's a bell-shaped curve with the peak around the middle, somebody with an associate's degree or a high school diploma. So you might have somebody who's an auto technician or refrigerator, HVAC technician, a nurse, that kind of person. And they make good tenants. So let's take a look at deep dive on that diversity. Another site that I like to look at, aside from niche.com, I'll show you here, is citydata.com or city-data.com. And city-data is not as polished a site as niche. It's basically a raw download of data from the Census Bureau. And so you have to wade through a lot of numbers, but it does have some good reports about crime statistics and others. So here's a drill down on the races in zip code 34472. So you can see it's pretty diverse. You got 58% white, 20% black, what is that, 16% Hispanic, and then there's Asians. So it's quite a mix. And that's important because it allows you, when you have a vacancy, you're looking for tenants, it allows you to cast a wide net. Just anecdotally, when was it, 2015, I was looking at properties in San Antonio, Texas. And in certain areas in the south side of the city, I was driving around, I felt like I was in Mexico. Everybody was Hispanic, all the signs were in Spanish, all the restaurants, all the grocery stores were in Spanish, were, you know, Mexican food. Nothing wrong with that. It's just that if I had a property in that neighborhood and I was looking for a tenant, there's really only one kind of tenant that would ever apply to live there. I'm very unlikely to get applications from white, black, or Asian people because that neighborhood was very monolithic. And that's what we like about this neighborhood. It's pretty diverse. If I have a vacancy, there's pretty much no one that wouldn't want to live here. I have a wide tenant pool to choose from. Whites, blacks, Hispanics, Asians, anybody could live here. So that's what it meant back up here when it says an A based on ethnic and economic diversity. And that's kind of what you want to look for. You'll appreciate it when you have a vacancy. Okay, so that's our look at neighborhoods. We did a little armchair analysis. We just determined that it was a solid B neighborhood. It's near the freeway and jobs. There's a high percentage of homeowners, 71% I think it was. We have a diverse tenant pool in the event that we have a vacancy. That's good. And overall, the area looks good. So a couple other notes about neighborhoods. Tours. We always recommended pre-COVID that investors, at least the first time, go out to visit a market in person. You can do so much from your desktop, but nothing beats actually going out there and seeing the neighborhoods and driving by, meeting the property management company, meeting the leasing agents, and getting a feel for the area. So if you're okay with getting on a plane and you've narrowed it down, that this is one market that you're seriously considering, you can always do a live tour and our property teams will set you up. If you don't want to do that, another option is a virtual tour. A lot of our teams are doing that now, where they'll take the property manager will take a camera and walk through the property room by room and record. Here's the cabinets we use, here are the fixtures we use, here are the floor tiles we use. So it's a very detailed look at that property, and they can give you a walkthrough as though you were there. So that's the next best thing. If they do that, though, you should ask them also to do up and down the street. You want to see what the neighborhood looks like. Are there other nice houses on the neighborhood? Are the lawns mowed? Are there junk collecting on a lawn? Are there nice cars or clunkers? Because your house might be nice and brand new, but if the houses around it are not as nice, then that's going to affect what kind of tenant you can attract and what kind of rents you can command. So make sure you, if you do a virtual tour, that you get the street as well. And here's a final tip. This is just something I do. Whenever I buy a property, I go to those sites like City Data and niche.com. There used to be one called crimereports.com, but it was taken down recently. I don't know why. But I take a look at those sites and I take screenshots of those reports and I save them in a Word doc and put it in my folder. It's 5 or 10 years from now when I'm planning my exit strategy, I can revisit those reports online and see what the neighborhood looks like then and compare it to what the neighborhood looked like at the time I bought the property. There's no way I'm going to remember 10 years from now what this neighborhood looked like and what the household income was and what the percent of owners to renters was or anything like that. So I like saving a copy of these in my folder for every property I buy. So as a best practice, you might want to consider doing that as well. So you have like a baseline that you can use for future comparisons. Hope that makes sense. Okay, that's it for our neighborhoods. So let's see, pro forma financial statements. So the property team sent you this pro forma, and we'll just go through it very quickly. Most of you are familiar with our pro forma format. What we're going to do here is just go through it line by line so you can see how to do a sanity check on these numbers to make sure they're in the ballpark. They don't need to be exact, but as long as they're roughly accurate. It seems like a tedious process, but it's not. You can really do it pretty quickly once you've done a couple of these, so don't be put off by the line-by-line explanation. It takes longer to explain it than it does to actually do it. So here's our standard format. The selling price was $160, down payment of 20% was $32, closing costs estimated at $4,000. So your total investment on this property would be $36,000. Now the property team is telling you, or the property management company is telling you, this will rent for $1,350. Your principal and interest payment, which is usually calculated on 20% down and 4% interest, is $609 a month. Property taxes are $200 a month. Insurance is $30 a month. And the property management, which is 8% of rents, is about $108. So your total expenses are $947. Subtracted from your rent, that means you have monthly cash flow of $400, $403, and an annual return of $48.36. And your ROI is simply your return on investment. So your return of $48.36 divided by your investment of $36 comes to 13.4%. Now that's pretty good. Double-digit cash on cash return on a brand new house. That's very good cash flow. You may remember at the beginning I said Florida was an appreciation market, but that was coastal Florida. Anything near the beach is going to be more expensive. This same house on the beach would be $200, $220 easily. So it won't cash flow as well if it was on the beach, but it has more potential for appreciation. This house is in the middle of the state, away from the beach, so it's actually a very good cash flow investment. But you as the investor, you want to take a look at this. How do you know if you can believe these numbers, or you want to do a sanity check? So let's go line by line and see how we do that. So first line is rent, $13.50 a month. And this is pretty straightforward. I think most of you are doing this already. To confirm rents, you just go to any of the real estate sites like Trulia, Zillow, Realtor.com, Redfin, and then plug in the zip code of the property, and then filter on the number of beds, number of baths, the square feet. Find houses that are similar to yours and see what they're going for. And when I did that, which site did I use? Zillow. I found that the rent range, you can see the first property there is $1,300 a month. The second one's $1,345, but they go up from there, $1,450, $1,475, and they go all, you can't see all of them, there's 10, but they go all the way up to $1,975. So the rent range for this type of property in this area is $1,300 to $1,975, and most of them are higher than $1,400. So at this point, you can check the box and say, okay, this rent estimate from the property manager is pretty accurate, and I feel confident that $1,350 is a realistic rent to expect for this property. That's your due diligence for the rent. While you're here, you might also want to look at other things like competition. You notice in the upper right-hand corner, let's see if I can, right about here, it says 10 results. So when we filtered on all these different properties, we came up with 10 properties, and that's pretty good. There's not that much competition. If you searched on this and found 30 or 40 properties, then that would be a red flag, because you've got a lot of competition. You may not get the rent that you think you're going to get because there's so many rentals on the market. You might have to lower your rents to attract a tenant. This happened to me in, when was it, Phoenix. My first rental property in 2004, I bought a house in Phoenix, and when I went to visit it, I was horrified. It was a new subdivision, and every other house on the street had a for rent sign in front of it, because investors were flocking there, and home builders were just building them and selling to investors. So that's kind of scary. It worked out in the end, but that's what you want to avoid. This map here shows you that of the 10 properties that are on this in the zip code, they're all spread out. They're not all on the street that your property's on. So that's a good thing. You want to see that they're spread out. Another thing to consider is you might want to loosen some of these filters, because your tenant isn't confined to brand new houses with the exact same square footage as your house. Your tenant might be okay with a house that's 10 years old or 20 years old if the rent is less, or maybe a house with less square footage. So you just play with the filters a little bit, see, you know, if you think like a tenant, if you were a tenant looking for a house in this area, what are your options? And make sure that you don't have a lot of competition and that the rents are realistic. Okay, so we got that one. Let's go to the next line item. Next is vacancy and maintenance. You'll notice the pro forma didn't have an estimate for vacancy and maintenance. If you look at any of our pro formas on our website, there's fine print underneath them, and we have a call out here. It says, we recommend that the buyer, that's you, set aside reserves for potential vacancies and or maintenance, typically 3 to 6% of rents. So we leave it up to you to plug in, because there's a lot of variance as to how much to put in for these numbers. So let's go to the next slide here. So we talk to the property management company and say, how long does the average tenant stay? And we find out it's about 30 months, 2.5 years is the average. So that means for every 30-month period, you'll have a tenant in place, and then the 31st month, you're going to have a vacancy as the tenant leaves, and it takes a month to find a new tenant and clean the carpet and touch up the paint and all that. So 1 month of vacancy for every 31 months equates to a 3% vacancy rate. And that times our $1,350 a month rent is about $50 a month. So in our case study here, we're going to plug $50 a month for vacancy to protect ourselves. Sooner or later, you're going to have a vacancy, so you should put that in there. And the same drill for maintenance. This is a new home still under builder warranty, so it's not going to require a lot of maintenance. But sooner or later, a toilet's going to clog up, or a garbage disposal is going to clog up, and they're going to have to send out a handyman to fix it. So you can reserve $50 a month as well for this, for maintenance. Now that's because this is a brand new house that's still under builder warranty. If you were getting a house that was in the Midwest that was 80 years old, then you might want to double that, you know, $100 a month. Plug that in and see what that does to the cash flow, and if the investment still makes sense. Some people use a rule of thumb, like 1% of the purchase price of the property in CapEx expense per year. So if you bought a $150,000 house in Indianapolis, you get to set aside $1,500 a year for maintenance. Basically, 1% of the capital stock needs to be replenished every year. You can work with your investment counselor too plug in some numbers that are realistic. All right, the next line item is principal and interest payment. That's pretty straightforward. You're financing a certain amount of money, 4%, 20% down, 4% interest for 30-year fixed loan, comes to $609 a month. What you can do is do some finance due diligence with your lender and find out if you get a lower interest rate if you put 25% down. And usually that's the case. So with 25% down, you can get half a percentage point off. So your monthly payments go from $609 a month down to $537 a month. It's funny, after 25% down, it really doesn't matter. You could put 50% down or 25% down, the rate will be the same. But there's usually a price break between 20 and 25. So as part of your due diligence, you want to ask your lender what's the price break, and then do some numbers, do some math, and see if it makes sense for you to get the lower rate. So in our case study here, we're going to do that. We're going to go for the lower rate. Let's see, other things relating to closing costs and fees. Since this is a new construction home, you might want to talk to the builder, because the builder might have his own preferred lender. And oftentimes they'll give you a price break if you use their lender instead of your lender. So RealWealth Network has 5 lenders on its website that we've vetted and approved and have been working with for years. But if the builder gives you a couple $1,000s off, then you might want to go with them instead of one of our lenders. As part of your due diligence, you should explore with the property team, if that's the case, if they have their own lender, and what the price break is. Most lenders are pretty close in terms of rates. You know, a 30-year fixed is going to be pretty much the same, but the largest variance is going to be with fees. So if the preferred lender gives you a break on the price or fees, then you should go with them. The next line item is property taxes. The pro forma, if you remember, shows $200 a month, which is $2,400 a year, and $2,400 a year divided by the 160 purchase price is 1.5% tax rate, and that's pretty realistic for Florida. A couple things you might want to look at though. In some of our markets, new homes are assessed differently than homes that have been around for a while. Like in Dallas, the taxes for the first year are just based on the land value, not the improvements. So the taxes, the property taxes in the first year are very low, and then in year 2 they go up after the property is reassessed. So our Dallas team is very meticulous about giving investors 2 sets of financial statements, one for the first year and then one for the subsequent years, so you can see what your first year cash flow is likely to be and then what your subsequent cash flow is likely to be. So that's typically not an issue, but you should just keep an eye on it. Another thing to look out for, if it's a renovated home, sometimes they use the taxes that were paid, the actual taxes paid for the previous year, and that could be misleading. So let's say the property team bought a house for, say, $70,000 and put $20,000 worth of improvements in it for a total of 90, and then they sell the property for 100K. The taxes shown might be based on that 70,000 number because that's what the house was worth last year. But going forward, your taxes will be based on the 100K, which it's worth now. So you should confirm with the property provider how they got their tax number. Was that based on last year's actuals, or is that based on the new value at post renovation? In general, property taxes is not a big issue. There's not a whole lot of gotchas here. They're pretty straightforward. The markets where you want to pay attention to it are Texas, like in Dallas. Property taxes are high in Texas, like 2.5%. And in most cases, the rents are higher also to help offset that. But you just want to keep an eye on that, make sure that that's the case, that the rents are higher. Basically, is the property still cash flowing well, even with the higher taxes? The other market to look at is Cleveland. Most of the properties are in the suburbs outside the city, and the property tax rates vary wildly from one suburb to the other. So don't just look at one number and then assume taxes are okay. For each property you get from that market, you should take a look at the property taxes. And again, see if the rents are high enough to cover it, and the property values, taxes don't kill you in cash flow. And just a note of trivia, Alabama has the second lowest property tax rates in the country, for those who are interested in keeping more of your rents. Okay, after property taxes, the next line item was insurance. The insurance on the pro forma was $30 a month, and at first that seems really low. And you say, oh, that's got to be a mistake, but it turns out it's pretty accurate. What it is, brand new homes in Florida have to be built to modern code, and they have to be hurricane proof. So they're designed to withstand 120-mile-an-hour winds. So you have very sturdy roofs, they're concrete block construction, dual pane windows. So they're very solid, and the insurance companies don't see much risk in insuring those. So the insurance is actually pretty low, $30 a month. The irony is if you bought a 40 or 50-year-old house in Florida, the insurance would probably be twice that because it's not built to modern code. So even though that looks suspicious, that's actually an accurate number. That said, you might want to decide you want additional insurance above and beyond what's required by the lender. The amount that's usually on the pro formas is what the lender requires. So you might want more than that. For example, there are some areas of Houston that had they weren't in flood zones, but yet they got flooded. So some people believe that the FEMA data that's used to determine flood zones is dated and not trustworthy. In fact, Realtor.com uses data from this site, floodfactor.com. So if you're in the coastal area of Florida or Houston, you just plug in the zip code of the property you're considering and see if this site, it's like getting a second opinion just to make sure as part of your due diligence. Does this property have flood risk? And if it does, then you can decide, talk to your insurance agent and talk about getting a quote about additional insurance for flood. The other kind of insurance you might want to get is an umbrella policy. I know a lot of investors like to use LLCs to protect themselves in the event of a lawsuit, but the other option is to use an umbrella policy. And the way that works, you can get $1 million policy for like $150 to $200 a year. And in the event you're sued or anything like that, the expenses come out of that policy and not out of your pocket. So in our example, we're going to add an umbrella policy. Since this property is inland, it's away from the ocean, we're not going to add for flood factor, but we will add for umbrella policy. The last line item on the P&L is the property management. And again, there's not much here. The property management fee is a percent of collected rents, usually 8%. So it is what it is. Now, remember when we first started, we looked at that rent of $13.50 a month, and we decided to leave it because it was realistic. If we decided that it was unrealistic and we brought it down to $1,200 a month, then this number would change because 8% of $1,200 is lower than 8% of $13.50. But otherwise, there's not much to worry about here. Property management is pretty much what it is. All right, so let's wrap it up. We have our original pro forma, which was given to us by the property team, and then we as savvy investors did our due diligence. So in the second column here, we say, here's our adjustments. We took the numbers that was given to us by the property team. We decided we're going to add more down to get a lower interest rate. And because we chose to use the builder's lender, we got a couple $1,000s off on the closing costs. Now we have some negatives here. We added a reserve from vacancy, a reserve from maintenance, and we also added an umbrella insurance policy, which increased our expenses by $15 a month. So that would have a negative effect on cash flow. But on the other hand, we have a positive effect on cash flow here because we changed the loan amount. We're only financing 75% instead of 80% of the property value. And in so doing, we got a lower interest rate. So when the dust settles, we make all of our adjustments. Here's what our revised pro forma looks like with the new numbers. And you see that the return on investment went down from 13% to 10%. So after doing your due diligence, you discover this. What does that mean? Does it mean you don't buy the property? No, not at all. This is a 10% return on a brand new house. That's pretty good cash flow. So you would probably proceed to go ahead with the investment. So even after doing all this number crunching, you convince yourself that this is a sound investment and you can move forward. I just make one observation here. You notice the change from 13% to 10%. What caused it? The annual return didn't change that much. It was only $500 a year because all these pluses and minuses that we added kind of canceled each other out. And the return is pretty much the same. The big difference was that we put $8,000 down more for down payment. So when you have ROI, return on investment, the denominator is investment. So if that goes up significantly, then your overall returns are going to come down. So at this point, you can reassess and decide as the investor, do you really want to do this? Do you want to put 25% down? Is it worth getting the lower interest rate if it affects your returns this way? And the answer depends on how long you're going to hold the property. The longer you're going to hold the property, the more advantageous it is to lock in the lower rate. So if you're going to hold it for 10, 20, 30 years, then you want to lock in the rate. But if you're only planning to hold it for 5 years, you can, it may not be worth your while. You might put less money down, get the higher interest rate, and then sell the property in 5 years. So you have to do the math. Your investment counselor can help you with that to see where the break even is. I did the math. The break even was at 9 years. So if you're going to hold the property for 9 years or longer, it makes sense to get the lower rate. If you're going to sell it in 5 to 7 years, then you'd be better off not putting the extra money down and getting a higher cash on cash return. Okay, so let's wrap it up here. Some final thoughts. This may sound like a lot of work and it sounds like it's tedious, but it's not. It's you can do these pretty quickly after you've done a few. I mean, how much time does it take to go to realtor.com and plug in the zip code and see what rents are going for in that area? Or it doesn't take much time to go to niche.com or city data and see what the neighborhood looks like. You can do these pretty quickly. And then when you work with specific property teams, you may notice certain trends. You may notice that this team tends to be too optimistic on rents. So when you get their pro formas, you just automatically deduct $100, or this other property team tends to be spot on, so I don't even need to check. I can just take it at face value. So don't be put off and think that you need to be a CPA or something to buy a property. It's not nearly as hard as it may look. And also, you should focus on big ticket items. Rents are the big one. If the rent's off by $100, say, let's say you raise rents $25 every year. If your rents are lower by $100 than what you're expecting, it's going to take you 4 years to get the rents up to where you thought they were going to be on day one. So that could be a real hit. So you want to focus on rents and make sure the rent projections are realistic. And if you do change it, that you can still live with the result, that the outcome is still good. Property taxes are generally not a problem. They are what they are, but in markets like Texas or Cleveland, you want to keep an eye on it to make sure that it's not an issue, that the rents are high enough to cover them. Similarly, maintenance is not usually an issue. About 75% of what our investors are buying right now are brand new construction homes that are still under builder warranty. So maintenance hasn't been an issue lately. But if you're buying one of those older homes in the Midwest, then you definitely want to keep an eye on maintenance. Unforeseen maintenance, $100 here, $200 there can eat away your cash flow. So you want to focus on those items. So if you focus on the big ticket items, this process will go even faster. The final thought or the final thoughts is my advice is to reserve the property first and then you do your due diligence. In some of our markets, properties sell really quickly, like in Florida. As soon as they put them out, they get sold, like within a day. The worst case is probably Cincinnati. The Cincinnati team puts out a list of properties every Sunday at 6 p.m. Pacific time, and by 6:05 they're all sold. I've had investors complain to me that they emailed within 2 minutes and the property was already gone. So that's really unnerving and disappointing. So I say, if you look at the Cincinnati properties week after week, you kind of get a feel for which ones you like and which ones you don't, what areas you like. So when you see one that looks promising, immediately reply to them. Send them an email saying, reserve this for me. Give me 1 hour to do my due diligence. And don't sell it, and then do your due diligence. If you do the due diligence first, then by the time you decide you wanted it, by that time it's gone. And so you don't want to be rushed. I mean, just on principle, you shouldn't have to make a $250,000 decision in 60 seconds. So reserve the property first and then do your due diligence. And the team will work with you on that. And if you don't want it, it's no big deal because they always have a waiting list. We'll just offer it to the next person on the waiting list. Okay, let's recap. We went through a lot of material here. I got on my soapbox. We're running out of time. We want to leave time for questions. All right, so for markets, you have to decide what your goal is, cash flow focus versus appreciation. Consider which markets have the type of property that you're interested in, single family versus multifamily. If you're doing a 1031 in particular, you should worry about which markets have lots of inventory to choose from, and also what weather conditions there are. For neighborhoods, just look at those sites that I pointed to, niche.com, city data. We've looked at those. I spot checked properties. I spot check properties that neighborhoods where I grew up in Philadelphia, definitely a B minus. Some neighborhoods where I went to school, definitely a C minus. And as far as I can tell, and our director of property teams can tell, these niche ratings are pretty accurate. So you can go by that, and they're objective. It's not like somebody trying to sell you a house telling you this is a B neighborhood. This is an objective, disinterested third party using data saying that this is a B neighborhood. Look at the demographics, the schools, the crime statistics. I forgot to mention about crime. When we have crime statistics, the thing to focus on is violent crime. Property crime is bad in itself, like graffiti or someone breaks into your car, but violent crime, like stabbings or muggings or something like that, that will make your tenant leave in a heartbeat. Your tenants will leave right away, especially if they have kids, and they'll break the lease. So you don't want to be in areas that are crime. Those are typically the D neighborhoods that we talked about at the beginning. So for most of our markets in B neighborhoods, you won't need to worry about crime that much. But if you're buying in the C neighborhoods of Chicago or say Baltimore, I would check on the crime statistics just to make sure that it's okay. And our property teams look at these statistics too, and they won't buy an area that has bad crime. But it's good to reassure yourself so you don't lay awake at night. And then what else? Look at owners versus renters, what the percent ownership is versus renters. A diverse population, so you have a wide tenant pool, and consider doing tours, both on-site tours or virtual tours. And also take a screenshot of these websites so you know you have a baseline that you can compare the neighborhoods to in the future. The pro forma, we went through line by line, how to evaluate rents and make sure they're in the ballpark, adding allowances for vacancy and maintenance, working with your lender on loans, confirming the taxes are okay, realistic, determining your level of insurance that you need, and then figuring out your optimal down payment and closing costs so you can fine tune your pro forma and make sure that it's accurate and there's no surprises after you buy the property. Okay, I see I got on my soapbox and we have 6 minutes to answer all your questions. So let's see what we got here. We might have to go over a little bit. This thing is pretty hard to read. Many markets are at peak value. How do you factor that into your due diligence? Well, that's a good question. Goran wants to know. You have to look at trends. All real estate is local. So property values are going up, interest rates are low. The Fed has said they're going to keep interest rates low for the foreseeable future. So I believe that we still have a long runway, that this is going to still keep going. The other thing is part of the reason for the home values going up is that building material costs are going up. So cost of lumber, cost of steel, concrete, blocks, everything is going up. And I think that's going to get worse before it gets better. The federal government is talking about spending $1 trillion on infrastructure. That means more roads, bridges, repairing airports, seaports, everything. So our property teams, the builders, are right now struggling to deal with these increased building costs for materials. But by this time next year, they're going to be competing with the federal government for those resources. So I think the property that you have now, that's 160, will be 170, 180, 190 next year. And it'll continue to go because $1 trillion, the government has deep pockets, so that's going to make prices keep going up. So those are my thoughts on that subject. What else do we have here? For areas like Huntsville, where can you get both positive cash flow and appreciation? What type of appreciation are you finding? That's always a crapshoot, estimating appreciation, because what happened in the past, the immediate past, isn't indicative of what's going to happen in the future. We've been seeing 7%, but there's a lot going on in Huntsville. Toyota is opening a factory this year that's going to create 4,000 jobs. The FBI has announced it's going to move 2,000 jobs from Virginia to Huntsville. So there's building going on all over. The population is growing and high-paying jobs are entering the area. So I would say Huntsville is in the second or third inning. I think you got more potential for appreciation in that market. Arash wants to know, may I ask what is special about Cincinnati? Our Cincinnati team has been with us the longest. They've been with us forever. They have a cult following within the RealWealth network. She does a great job of renovating homes. She takes care of her investors. She has a great reputation, and everybody wants to buy in Cincinnati. It's a great cash flow market. So because of her cult status within the network, everybody wants to buy a house in Cincinnati. So that's why. Let's see. I have seen aggressive rents in outlying areas of Charlotte that have been difficult to justify based on my research. The builder claims the rents are changing quickly and will rise to those levels by the time the house is built. Any advice for estimating growth? Oh, that's tough. Typically in Charlotte, the builders build the properties within 120 days of when you send over the earnest money deposit. And I don't know that rents are going to increase that much in 120 days. Ask them to justify to you why they think it's going to go up that much. I would put in a realistic number based on what you see online. And if you have any surprises, the surprise will be to the upside. The builder's trying to sell you the house, remember. Now, let's see, any other questions? It's hard to read this thing. What good is due diligence if the home builder can raise the price of the property? Okay, this is a question that's been coming up lately. In some of our markets, particularly Florida, are where there's a long lead time. Typically, you would put earnest money deposit down, and then 9 months later, the house will be built. Well, over the past 9 months, like I said, building materials have gone up in price, and our home builders can't build them because if they did, they would lose money. So the $160,000 house that you have on the contract, they tell you the price is now 170. We have to change the terms of the contract, and that's ruffled a lot of feathers, and a lot of our investors are concerned about that. But when you look at it, most of our investors, almost all, I think one backed out of a deal, but everybody else has decided to move forward. And the reason that two points I would make. Number one, raising the price by 10,000 sounds like a lot, but when you consider 20% down, we're really only talking about $2,000 out of pocket. So instead of putting $30,000 down payment, you're putting 32,000. So that's not that much of a difference. Also, your monthly payments might go up by $30, and that's annoying. But if you've been waiting 9 months to have this house built, do you really want to cancel the deal because of $2,000 of out of pocket? Probably not. The second point I would make is the one I've just made. Building material costs are going up, so there might be a silver lining in all this. As this continues, as the government gets involved with infrastructure spending and home building materials continue to rise, that 160 house that you now have to pay 170 for will be worth more next year, 190. So nobody can know for sure, not predicting. So, but just take that into account that this is likely to continue. And so there might be a windfall in terms of price appreciation. So when you balance all the pluses and minuses, all of our investors have moved forward, except for one that I know of that backed out of a deal. So no guarantees, but that's the way it looks to me. I think we're in for a long period of increased prices. By the way, every year in January, Kathy does a special webinar on the economic outlook for the new year. Right now, the legislation about this infrastructure bill isn't firm yet. It hasn't passed, but by January, we will know a lot more about what it passed and what effect that's going to have on real estate investing. So look out for Kathy's beginning of year webinar so you can get a better feel for how that's going to affect your investments. Melody asked, do you have a similar process that you recommend for STRs? I assume that means short-term rentals. The answer is no. We don't really deal in short-term rentals that much. Just recently, in the past couple of months, our Jacksonville team has offered some. They found some good ones and are offering those to our investors, but we don't broadcast them. We don't have webinars on them. It's kind of an exception to what we normally offer. So we have this due diligence process for single-family homes, but not for short-term rentals. So how would you do that? How would you confirm rents? That would be hard to do, especially with the virus. Do people really rent. You'd have to talk to whoever's selling you the property, ask them to justify to you why they think the rents are going to be there, and then see if it's credible. Let's see, Sandy wants to know, do you have an Excel spreadsheet that you use? Yeah, it's nothing special. If you copy and paste any of our pro formas into a spreadsheet and then create an extra column for your adjustments, then you can, then make a third column that says, here's what the net is after the changes. That should be enough to give you an idea of the new pro forma after you made your adjustments. Let's see. Sloan wants to know, can you recommend companies for good umbrella insurance? Actually, that's done at the local level. So whoever you get your property insurance from, you talk to the insurance agent, you ask them and say, I'm interested in an umbrella insurance policy in case I get sued or have legal fees. Give me a quote. I want $1 million policy. What's that going to cost? So that's how you do that. The local team can help you with that. We do have a national insurance agent. It's on our website, and they tend to be competitive. If you have properties in multiple states and you just want to get one policy for all of them, you can go to our website and find that insurance agent and see if they can cover you. I believe they're competitive, except for Florida. They tend to be high in Florida. But if you have multiple properties that you want to have one umbrella policy for all of them, you can talk to that source. I'm sorry, I don't remember the name off the top of my head. Thoughts on Columbus, Ohio? We like, Joseph wants to know about our thoughts on Columbus. We like Columbus as a market. It's got the University of Ohio's there, very good market, good for cash flow, but we haven't found the team that we want to work with. So we're not there. We're in Cleveland and we're in Cincinnati. Let's see, this question. Arash says, just to understand, we don't lock the price when we put the deposit for pre-construction homes. Normally you would. Normally when you put your earnest money deposit down, that would be the case. You're locked in at today's price and any upside is yours. But unfortunately, in the crazy environment we're in, the home builders are going to lose $10,000 on each house, and they're building 20 or 30 of these at a time. They can't afford to take the hit. So there's fine print in the contract that says if there's what's it called, force majeure, some occurrence, an act of God that's out of their control, that they reserve the right to change the price. So unfortunately, it's only affected our Florida team so far. But if this building materials shortage continues, it might spread to some of our other markets, any place where there's new construction. So you can talk to the local team to find out. Let's see. I think that's about it. We're a little bit over time. See if there's any more questions here. The box here with the questions has only one line, so I can't. Okay. Amy wants to know, how much coverage do you recommend for an umbrella policy if I own multiple rentals? I always get $1 million per property because it only costs, $180 a year, $15 a month. But it depends on the state and how litigious it is. California, there's a lot of lawsuits. If it's a landlord-friendly state, you should be okay. So it's a judgment call. Talk to the insurance agent and find out, how often does this really happen? How often do landlords actually get sued? And usually it doesn't happen that often. It's something that is a theoretical possibility, but that doesn't happen really that often. And if you own a multifamily, you'd be more inclined to get more insurance, because in a multifamily, like a fourplex in Chicago, you have 2 units upstairs, 2 units downstairs. The landlord is responsible for certain things, like the smoke detectors in the hallway or the shoveling the snow in the wintertime. So you have more liability with a multifamily in those kind of markets. So you might want to get more insurance rather than less. You can talk to your investment counselor and give them more specifics about which markets you're in, and they can help advise you. I don't have, let's see, I don't have W-2 income. Can you say how to find lenders who base loans based on property value and rental income? Yeah, you go to our website. We have conventional lenders, and then we have non-conventional lenders. So if you don't have a W-2 income, you would talk to the non-conventional lender. Ridge Lending is one of them, and Corvest is the other. And talk to them about your situation and see if they can help you get a loan. Let's see, Robert wants to know, can you recommend online tools and apps for evaluating a rental property, including fields like on a pro forma? Well, yeah, there's one on our website. If you go to our homepage, on the right-hand side under Investor Resources, I think it's the last line item there, and it says Property Evaluator or something like that. And it basically pulls up a spreadsheet, and you can use that to do the kind of analysis that I just walked you through today. All right. Amy wants to know, do you like rentometer.com for rent calculation? That's a good question. No. The other sites tend to give me pretty much the same answers when I spot check them, but Rentometer I find is consistently off, way off. So even though that's what they claim their specialty is, I don't particularly care for that site because I can't trust their results. I don't know where they get their numbers. But they're completely off from what you'll get from the other sites. I would look at the other sites and, look at 2 of them and get a second opinion, and that'll give you a good idea of how reliable or stable the estimates are. Okay, we've gone over, so we'll wrap it up. So what's next? Book a session with your investment counselor, and visit our investor portal for more information on the property teams and sample properties so you can start doing your own due diligence. Just a editorial here. I've seen lots of investors over the years who've been members with RealWealth Network for years. They attend all of our Thursday webinars. When we had live events in California, they used to attend our live events. But even after years of being a member, they never buy a property. And I always wonder why that is. And I think it's because they're not quite convinced that it's a good investment or a safe investment. I think it's like analysis paralysis. So hopefully the due diligence steps we walk through today would give more people a sense of confidence that you can look at an investment opportunity and evaluate it on your own and independently arrive at your own conclusion. So you can get off the fence and invest in a property and get your investment career going. Real estate investing is great for building wealth and for achieving financial freedom over time. But real estate doesn't work if you don't buy properties. So whatever it is that's holding you back, schedule a session with your investment counselor and say, this all sounds good, but I'm hung up on this issue or this question, and see if they can get you unstuck so you can start investing in property. Okay, as always, this webinar has been recorded and will be posted on our website by this time tomorrow, or at the very latest by the end of day. So if you go on our website, if you log in with your user ID and password, and then get into the investor portal, on the left-hand side of the menu bar, there's a line that says recent webinars. You just click on that and you'll find a recording of this webinar. We covered a lot of material today, so if you want to go over it a second time to let it sink in, you can do that as many times as you want. Okay, that concludes today's webinar. Thanks for watching. I hope you got something out of it and found it worthwhile. Enjoy the rest of your day. Goodbye.